Well, now to a fixed income conversation, but not as you know it, specifically a conversation about unlisted corporate debt. Andrew Lockhart runs Metric Credit Partners, and he joins us now to talk through the risk return proposition and options that exist. He joins us now live via Skype. Andrew, welcome to the program. Give us some insight as to this fund that you've set up.
Oh, thanks for having me. Look, the fund that we set up was really designed to give retail investors an opportunity to participate in our activities of directly originating and lending to Australian companies. The fund seeks to provide investors with a diversification across a range of corporate borrowers with income paid to investors on a monthly basis, low fees, but also designed to really cater to individual investors' access to investment choice and product based on investors' expected risk, return, and liquidity or redemption options that they require. And so it's a broad-scale fixed income opportunity where we raise capital from investors, and we use those proceeds to directly lend to Australian companies.
Okay, so Andrew, it's great to have you joining us. I'm curious to know, I heard you present at an event a couple of months ago. It was actually pre-COVID because we're all sitting in a room together beside each other, shoulder to shoulder. I'm curious to know, how have the companies that you've invested private capital into fared during this pandemic?
Very well, to be honest. We cover a range of borrowers from very high investment grade through to sub-investment grade. It has been a unique situation where not all companies have experienced the same outcomes. So our activities really span a number of areas. One, we lend to publicly listed companies, so companies that are listed on the stock exchange. We're active in providing financing for a range of large-scale project and infrastructure-related borrowers. We provide financing for commercial real estate or predominantly property development activities, so construction loan facilities for, say, residential apartments or land subdivisions. And we're also active providing financing for a range of private equity-sponsored acquisition financing facilities. What we've seen over the last couple of months is really, I guess, a number of companies that have benefited as a result of the government policies and the initiatives that they've taken. But also, we've also seen companies go and raise additional equity, using those proceeds, obviously, to restore liquidity buffers and to have sufficient capital. But recognising where we sit in the capital structure, obviously the risk to most investors is in the form of their equity exposures. So investors invest in the equity part of the capital structure, basically looking for growth and capital gains. They invest in the debt part of the capital structure, where we lend, to have lower volatility and greater protection of their capital. And so for us as a lender, we obviously seek to negotiate appropriate terms, conditions, taking covenants, taking security, all designed to mitigate and lower the risk to investors' capital. And so what we've seen from a range of our companies that we lend to, they've weathered the storm quite well. And that's been across a number of industries. Particularly, we were fortunate that in the construction sector, there wasn't any general shutdown of the construction sector. And so a lot of the projects that we were financing were able to continue on without being impacted. But certainly in other parts of the market, companies have been impacted, their businesses have been shut down. And obviously from a lender's perspective, a big part of that is ensuring that the companies have adequate available liquidity to be able to weather and trade through that period of hibernation. And that means lowering their cost base, absorbing their cash buffers, but then being in a position where they can come back online and commence their operations and generate income and earnings again to service and repay their debts.
Yeah, Andrew, correct me if I'm wrong, but you did have some exposure to the hospitality related areas of the market. Have there been any covenants that have been breached, or has that been a particular area of focus for you?
Yeah, so what you get is the difference, I guess, between a public market loan or a bond versus a privately negotiated transaction between ourselves as a lender or with the banks providing financing to a company is that we're privy to a private side information. And so when you negotiate covenants and the like, they're designed to provide early warning signals to you of any deterioration that requires the company to contribute additional equity or to contribute additional capital to ensure that you as a lender are not at risk of loss. Obviously, in those circumstances, their businesses have been substantially impacted as a result of the government shutdown measures, where their earnings and income and revenue went to zero. And so from a lender's perspective, what you need to consider is, yes, there may be a requirement to amend or renegotiate a covenant, but it's done on the basis that you believe that the company has the capacity and the going concern value that will be protected over time. And so you're trying to work with companies to ensure that, when they come through this period of time, that they can re-establish their operations, generate cash flows, and be able to service and repay their debt. And obviously the companies we lend to have sufficient cash on balance sheet or available liquidity lines, committed funding lines that allow them to sustain a period where there's no income being generated and then move through to a period of normalised operations.
Andrew, very quickly, what is the largest challenge facing the private markets in Australia at the moment?
The largest challenge?
Yes.
Look, I guess it's interesting because I guess the demand, for a lot of corporate debt at the moment would be being impacted. So I guess from our perspective as a lender, where market conditions, economic or business conditions display a degree of uncertainty, as a conservative lender, you take a position where you want to have a greater level of clarity and understanding as to the forward position of the companies that you lend to before you start to commence, new lending activities. And so I guess for a lot of lenders, it would be, let's see how the market conditions pan out. There may be a requirement for borrowers to pay higher margins, higher fees, but it also is important that you as a lender have good visibility over the likely forward projections and earnings capacity of the companies you lend to. And so, generally right at the moment, I would say that non-bank lenders are probably taking a little bit more of a conservative view, with a view that when economic and business conditions normalise, that will create opportunities to again provide financing for these companies.
Andrew, thank you so much for joining us to talk through some of the areas of the market that you work in, and of course to let us know about this direct income fund that you're launching today. Appreciate it.
Thank you for the opportunity to talk.